Hi, all. Brian Manier here with Keystone Financial Group. And with the new administration now in the office for approximately a month now, there's been a lot of discussion and a lot of noise about tariffs. A lot of people are confused of how this is going to affect them personally. So I thought I would provide an update of what is a tariff and how is it going to impact you as the typical investor. I thought the best way to do that is just start off by providing the definition of a tariff. What exactly is a tariff? Well, it's imposed by a government on the import and export of goods. These are specifically taxes, typically calculated as a percentage of the value of those goods. They serve as a tool for generating revenue and regulating trade by influencing the costs and competitiveness of imported items. Now, these have been around for many, many years, where we may typically see this specifically in the U.S. when there are companies that are headquartered overseas. Tariffs are then implemented for those goods brought into the U.S. And what we have seen over time are sometimes those companies will actually set up manufacturing plants in the U.S. to help avoid those tariffs. Now, the importance for investors is that tariffs can significantly influence market dynamics, affecting supply chains, pricing strategies, and ultimately corporate profitability. Now, there are different types of tariffs. First, there are import tariffs. These are tariffs that are levied on goods brought into a country, typically designed to protect domestic industries by making imported goods more expensive. This can lead to domestic price increases and shield local producers from foreign competition. You also have export tariffs. Now, unlike import duties, export tariffs are taxes applied to goods leaving a country. This is often used by governments to control supply, maintain favorable prices for domestic consumers. The impact for exporters by eroding their competitive edge abroad. And then you have specific tariffs. Now, these are set amounts imposed on certain goods, regardless of their value, providing a straightforward model for governments to raise revenue. Specific tariffs can disproportionately affect lower value goods. And what this means is industries may adapt differently to these pressures. Now, we've seen this, for example, in the steel and aluminum imports, and this has happened in recent history. So what is the impact of this? Well, the impact on tariffs on domestic markets first is price inflation. So tariffs typically lead to increased prices, at least in the near term, for consumers as import costs rise and businesses pass on these expenses to the consumer. So this is typically going to result in inflationary pressures, and this can dampen consumer spending and economic growth overall. We can also see this to cause supply chain disruptions. The imposition of tariffs that can trigger shifts in supply chains, forcing companies to reconsider sourcing strategies, and increased costs may lead to reevaluated supplier relationships. This also causes consumer behavior changes. Consumers may respond to rising prices by adjusting their purchasing habits or turning to domestic alternatives. And this can lead to unforeseen shifts in market demand that can ripple throughout the economy. And it's hard to know with these that if these are going to be long-term or just short-term impacts. Now, what's important to also understand is how these can influence market confidence. So the first thing that we would consider is how this is going to impact market volatility. Sometimes tariff announcements, they can create significant market volatility. Investors are going to react to potential shifts in earnings, expectations, and economic conditions. This can lead to rapid price adjustments and heightened uncertainty in the markets. Investor reactions, they can react differently. Reactions from investors can vary widely. This can range from panic, selling to strategic repositioning of assets. It can showcase psychological impact on tariffs on market participants and their investment strategy. So there can be an initial reaction by investors. There's psychological factors, the mere anticipation of tariffs, with some can invoke fear and speculation among investors. It will influence their decision-making process, leading to shifts in investment strategies. And sometimes this may not reflect in the actual economic fundamentals or economic conditions. And so some of these responses, understanding of investment sentiment is critical. Allowing analysts to gauge market reactions based on prevailing narratives, that can be a dangerous reaction by just making an impulse reaction to hearing about a tariff. So there are certain industries that are affected by tariff implementations. So industries that benefit from tariffs a lot of times are sectors such as domestic manufacturing and agriculture. They can experience advantages from the tariffs because the rise in cost of goods and services coming into the country can make them more competitive if they are creating those here in the U.S. Now, conversely, industries reliant on imported materials, these can be things like technology and possibly automotive manufacturing. They may suffer increased costs and diminished competitiveness in global markets. So what do you do with this? What can you do specifically to make sure that you are prepared when all this starts to happen? Well, the first thing is diversification within your investment portfolios. So when we are recommending portfolios to you, we always recommend that these have heavily diversification with different types of market capitalization and emerging and international equities inside those particular models. So these can be something that you can implement, these diversified portfolios across multiple sectors, geographic regions, and this will mitigate risks and hopefully capitalizing on those emerging opportunities. The other thing that you need to make sure that you have an understanding is the long-term versus short-term strategies. This is why we always talk about the bucket plan, making sure that you have a solid bucket plan in your overall financial plan. Because what this will drive is if you have a strategy that you don't need to take distributions for a long time, even if there are initial reactions that cause, whether it's losses to the portfolio or other negative considerations, you have time for that portfolio to rebound. Versus if it's a strategy that you need distributions relatively in the near term, then you can make sure that you set that up accordingly and you put it in a strategy that's not going to have the impact of what these tariffs can do to not only your overall portfolio, but to the overall economy. So if you need to have a conversation with us or you want to talk about this a little bit more and what kind of impact it may have on your specific financial plan, reach out to us. We'll be happy to talk to you. As always, we enjoy the opportunity to discuss these with you. Thank you so much for listening to this and look forward to talking to you in the near future. Have a great day.